Hello everyone, I'm Anyway Financial. Today, I'm excited to walk you through two powerful investment strategies that allow investors to profit when they believe a stock price will decline. We'll be exploring short selling and put options, two bearish strategies that, while different in their mechanics and risk profiles, serve the same fundamental purpose, capitalizing on downward price movements. By the end of this presentation, you'll understand how each strategy works, when to use them, and most importantly, the risks involved with each approach. Let's dive in. Let's start with short selling, which is the more traditional approach to betting against a stock. At its core, short selling is the practice of selling securities you don't actually own, with the expectation of buying them back later at a lower price. I know that sounds counterintuitive. How can you sell something you don't own? Well, this is where borrowing comes in. The process follows four key steps. First, you borrow shares from your broker. These shares typically come from the broker's inventory or from other clients' accounts. Second, you immediately sell these borrowed shares at the current market price, receiving cash for the sale. Third, you wait, hoping the stock price will decline. And fourth, once the price has dropped to your target, you buy back the same number of shares at this lower price and return them to your broker. The difference between what you sold the shares for and what you bought them back for minus any borrowing costs and fees is your profit. It's essentially buying low and selling high, but in reverse order. Let me illustrate this with a concrete example. Imagine stock XYZ is currently trading at $100 per share, and you believe it's overvalued and will decline. On day one, you borrow 100 shares from your broker and immediately sell them at the market price of $100 per share. You now have $10,000 in cash, but you owe your broker 100 shares. Fast forward 30 days. Your analysis was correct, and the stock has dropped to $70 per share. You now buy back those 100 shares at $70 each, costing you $7,000. You return these shares to your broker. Your profit? $10,000 received minus $7,000 spent equals $3,000 in profit. That's a 30% return in just 1 month. Not bad, right? However, and this is crucial, this example assumes everything goes according to plan. In reality, markets don't always cooperate with our predictions, which brings us to our next slide. Now for the sobering part, the risks of short selling are substantial and require serious consideration. The first and most critical risk is unlimited loss potential. When you buy a stock normally, your maximum loss is limited to what you invested, the stock can only go to zero. But when you short a stock, there's theoretically no limit to how high the price can rise, meaning your losses can exceed your initial investment many times over. If you shorted stock XYZ at $100 and it rises to $200, you've lost 100%. If it goes to $300, you've lost 200%. You see the problem. Second, margin calls can force your hand at the worst possible time. Since short selling involves borrowed shares, brokers require you to maintain a certain amount of capital in your account. If the stock price rises significantly, your broker may demand you deposit more funds immediately. If you can't meet this margin call, the broker can close your position at a loss without your consent. Third, borrowing costs eat into your profits. When you borrow shares, you pay interest to the broker, similar to paying interest on a loan. For hard-to-borrow stocks, these fees can be substantial. You're also responsible for paying any dividends the stock distributes while you're holding the short position. Finally, there's the short squeeze risk. This occurs when a heavily shorted stock suddenly rises in price, forcing short sellers to buy back shares to limit losses. This buying pressure drives the price even higher, creating a vicious cycle. We've seen dramatic examples of this in recent years with certain meme stocks, where short sellers lost billions. These risks make short selling a strategy best suited for experienced investors with strong risk management practices. Given these risks, many investors turn to put options as an alternative way to profit from declining stock prices. So what exactly is a put option? A put option is a contract that gives you the right, but not the obligation, to sell a stock at a predetermined price, called the strike price, before a specific expiration date. This is a critical distinction, it's a right, not an obligation. If the market doesn't move in your favor, you can simply let the option expire. Let me explain the key terms. The premium is the price you pay upfront to purchase the option. This is your maximum loss. The strike price is the price at which you have the right to sell the stock. And the expiration date is the deadline by which you must exercise your right or the option becomes worthless. Now, why would someone choose put options over short selling? There are several compelling advantages. First and foremost, your risk is limited to the premium you paid. If you buy a put option for $300, that's the absolute most you can lose, period. There are no margin calls, no unlimited loss potential. Second, you don't need to borrow shares or pay borrowing costs. Third, options provide leverage, meaning you can control a large position with relatively little capital. And fourth, you have defined risk from the outset, making risk management much more straightforward. Put options are particularly useful when you believe a stock will decline, but you want to limit your downside risk and avoid the complications of borrowing shares. Let's walk through a practical example to see how put options work in action. Imagine stock ABC is currently trading at $100 per share. You believe it will decline, so you decide to buy a put option. You purchase one put option contract, which represents 100 shares, with a strike price of $95. You pay a premium of $3 per share, which equals $300 total. This option expires in 30 days. Now let's look at two scenarios. In the profitable scenario, suppose the stock drops to $80 per share before expiration. Your put option gives you the right to sell shares at $95, even though they're only worth $80 in the market. The intrinsic value is $15 per share. Subtracting the $3 premium you paid, your profit is $12 per share, or $1,200 total. That's a 400% return on your $300 investment. In the loss scenario, imagine the stock stays at or rises above $95. In this case, your option is worthless. There's no point exercising the right to sell at $95 when the market price is higher. The option expires worthless, and you lose the premium you paid, $300. But notice, that's your maximum loss. No matter how high the stock goes, whether it's $100, $200, or $500, you can only lose that initial $300 premium. This defined risk is what makes put options so attractive for bearish speculation compared to traditional short selling. Let's bring everything together by comparing these two strategies side by side. When it comes to risk level, short selling carries unlimited risk, while put options limit your risk to the premium paid. This is perhaps the most important distinction between the two approaches. Regarding initial costs, short selling requires meeting margin requirements, which can be substantial, whereas put options only require the premium, making them more accessible for smaller investors. For profit potential, both strategies can be highly profitable. Short selling can theoretically return up to 100% if a stock goes to zero, while put options offer leveraged returns that can exceed several 100% due to their leverage characteristics. Time constraints differ significantly. Short selling is flexible. You can maintain the position as long as you meet margin requirements and pay borrowing costs. Put options, however, have a fixed expiration date, meaning you must be right about both the direction and the timing of the price movement. Finally, in terms of complexity, short selling is moderately complex, mainly due to margin requirements and borrowing mechanics. Put options are generally more complex because they involve understanding option pricing, time decay, and volatility, concepts that require additional education. So here's the key takeaway: both strategies allow you to profit from declining stock prices, but they suit different risk profiles and market outlooks. Short selling offers more flexibility and direct exposure to price movements, but comes with unlimited risk and borrowing complexities. Put options provide limited risk with leveraged returns, making them safer in terms of downside protection, but they require precise timing and lose value as expiration approaches. Before implementing either strategy, always carefully assess your risk tolerance, market conditions, and ensure you fully understand the mechanics. These are sophisticated strategies that, while powerful, can result in significant losses if not properly managed. Alright, that's all for today's short selling and put options. If you like this video, please like, subscribe, and share. Thank you everyone, see you next time.